Storm has special expertise in B2B. I think you have always done only B2B.
Yes. One of the things before we invest in companies, we think a lot about is what is the pain you're solving and how urgent that pain is. Is the problem something that needs to be solved today, or can I wait 6 to 12 months? So we spend a lot of time thinking about urgency.
But let's say today the markets are changing so dynamically with Anthropic launching methods. Where do you think the moats remain in vertical or horizontal applications?
I mean, it is getting harder. If you're just a pure application UI level company, I think it's very hard for you. Now, the models will get better at all of these, but their role, at least today, would be to provide the best model that they can. Everything you build on top ultimately comes down to somebody else. And I think there's a big gap between the application and the model. So go build for that gap.
What's been your learning from companies that you were very bullish about, invested in, but they didn't work out?
I think
Hi, this is Siddharth Alwalia. Welcome to the Neon Show. I'm your host and managing partner at Neon Fund, a fund that has invested in some of the best enterprise AI companies that have come from India, building for the globe, like Spotraft, CloudSec, and Atomicwork. Today, I have with me Arun Penmetsa. Arun, welcome to the Neon Show.
Thank you, I'm Sid. It's great to be here.
Yeah, Arun, so Storm is a legendary name in venture capital in Silicon Valley, right? It's a 25-year-old institution, right? You're on to the fund 7 now,
Yes.
if I'm right. It's a 200 million plus fund.
Yes.
And you have backed some of the great names across the US-India corridor, as well as only US names. For example, a name that everybody knows in India is Tekion.
Right.
Right? Just fairly popular in India. And the company today is more than 300 million in ARR, last valued at more than 4 billion. And Storm has special expertise in B2B. I think you have always done only B2B.
Yes. That's right. Yeah. Yeah. Storm, as you said, we started out about now 26 years ago.
Yeah.
I think 2000 was the first fund that took outside capital. There was a fund before that the founders put money in themselves. But yes, we have focused on B2B throughout history, and we can go into reasons why. But it's been a great journey. We've been fortunate to invest in companies like Tekion and many others with amazing founders. And hopefully there's a good journey for the next 20 years.
And you have also been on the first check in Marketo. Marketo is also, 100 million plus ARR. Last public numbers are like 5.7 billion in market cap, right? So the first is, what has helped Storm build the right to win such companies?
Yeah. So Marketo, we led the Series A. I don't remember if you were the first check, but I think there's a few things that we tend to spend our time on. One, I would say, given our B2B focus, one of the things we think very deeply on is what are the patterns that we've seen repeat over time, right? I think we've done something like 200 investments over that time frame. So we tend to think a lot, especially on the go-to-market side. What does it take for a company that has some revenue to transition from founder-led sales to building out a go-to-market team? How do you think about the right go-to-market for your company? How do you think about the right pricing for your product that go-to-market can eventually support? How do you think about hiring the right people to fit that go-to-market? So one, I think we have seen patterns over the years, and we had this conversation before the podcast started, but if you think about B2B, like every sector is different, right?
Yeah.
You have cybersecurity, you can have sales tech, you can have healthcare or construction. But one thing we've found over the years is when you sell to a type of buyer, whether it's SMB or enterprise, the process tends to have patterns. How do you think about figuring out the right pain point?
Sure.
How do you think about bringing the rest of the organization along in addition to your champion? How do you think about moving deals through procurement and legal? How do you think about objection handling? How do you think about compliance? How do you think about the right way to price deals? So I think one of the skill sets that we bring is, as you build out your company and think about go-to-market, is how do you structure that for success? I think that's one. I think second, we tend to be, or at least we think we tend to be relatively good partners for the long term, right? I mean, Storm has been involved with companies that have done really well, and we've been with them throughout the entire journey. So, our goal is to help the company and the founders succeed. So I think founders appreciate that, we are in many ways easier to work with and tend to work throughout the journey. I think third is also just economic cycles, right? I joined Storm. I wasn't there since the beginning, but like, if you think about the founding team, I mean, they have seen, depending on how you count, 2 or 3 economic cycles, right? So that's one benefit I get a lot when we're sitting in these meetings is you see valuations going up, you see valuations coming down, you see buyers being very aggressive adopting software, and you see periods where they're pulling back. There's no budgets for anything. So I think just having that perspective and that long-term view could also be helpful to founders as they think about what's next. So those are some reasons.
Yeah. And there have been like 7 great exits in the recent years. AirGap is one of them. Dasera is one. TrueStar, ForMe. So ForMe became Zurant, right?
Right.
And they acquired one of our portfolio companies, ZenDuty.
Oh, great. Yeah. Fantastic.
Right.
Small world.
Then there's Rally Team, MyAlly, Limbix, right? And they all have been great exits. Can you talk about some of these exits? What has led to them in the last, let's say, few years?
Yeah. So I think there's a few patterns. I think one, as far as I remember, in every one of them, the founders have deep domain expertise, right? They really understood the pain point. And this is something we can talk about more about. But one of the things before we invest in companies, we think a lot about is, what is the pain you're solving and how urgent that pain is. And I think the urgency part is hard to figure out all the time.
Can you give examples?
Yeah. So like, if you think about AirGap, right?
Yeah.
It depended on the customer, but when they were trying to build out sort of this, they started out in network segmentation and eventually they grew a lot more. When the pandemic hit and you had all these factories where you still had to come in and do work, you couldn't work remotely, right? I think the pain really was, attacks are happening, the pace of attacks security attacks is happening, the pace of them is increasing, they're getting more sophisticated. How do I build my network to protect against that? And when we think about urgency, we think of it more as, is the problem something that needs to be solved today, or can I wait 6 to 12 months, right? Because if you can wait, yes, if it's a great solution, I'll still buy it, but it's not truly urgent. It's probably in my not in my top 2 or 3 list. So we spend a lot of time thinking about urgency. So I think in all these companies, and to varying degrees, right? The founders had a good idea about where the urgency lay. Now, some of these exits were better than others, so the exact level varies. But I think that's one. I think deep domain expertise gets you that. I think the second thing is if you have a good product sense, that also helps trying to understand. So I think that was one. I think second, if I think about all those founders, they were very, very good at product, right? They really understood what the customers were looking for, how to build for that. And, this is sort of a cliche today, but it's very important, is they're always customer first. Whatever they really want to solve the problem for the customer. So I think that is the second one.
Yeah. And was it the industry also that influenced these exits? Like they were sitting in the right industry at the right time? Maybe you can...
I mean, some of it, yeah. I think, again, if you think about, just because you mentioned AirGap, and I'll mention one other example after that, I think the product that they built became very strategic because at that time, there weren't many companies that were agentless. So, AirGap didn't have to deploy agents on every device.
And can you let's take the case study of AirGap?
Yeah.
What did they do? How did you meet the founder?
Yeah.
How much did they raise in the journey?
So I met Ritesh, gosh, I'm trying to remember now. I think I probably met them through the seed investor, maybe about 6 to 9 months before we actually invested.
This is which year?
I want to say 2021 maybe. Sure. I think that's right. Yeah. Because they exited in 24. Yeah, so it must have been 2021. So I met him early, and at that point the company was very early. Like, I don't think they had any revenue. Ritesh had an incredible vision for where he thought networking should go, and how do you build the right infrastructure to secure it. And this is sort of a very simplified version, but a lot of security, when you think about networks, is that one of the easiest ways is to put agents on every device. Yeah. Your small piece of software that is tracking what's happening on the device, whether it's the server, whether it's a camera, anything, right? But obviously putting agents on something is work. And in many cases, even customers don't want to manage thousands of agents running in their environment. And this becomes even more hard when you go into something like a factory, which are probably running machines that are very specialized, and they are probably running some OS that is 15 years old, because you don't want to touch these and upgrade these, because even a small amount of downtime can be extremely costly. So one of the innovations that AirGap did was they came up with this agentless architecture where they would sort of sit in line. So they would see all the traffic, and based on their product, they would figure out what looks like a threat, what doesn't look like a threat, how do I manage these devices and all that. So it was, especially for that market, the non-IT, sort of the OT market, that was really, really powerful, right? Because these factories and industrial sites, or in some cases even campuses, didn't want to suddenly deploy tens of thousands of agents in the network. So that was what they're doing. The team was fantastic. They had deep networking background. They had been at Juniper before and a number of other companies. So I think technically they were able to really build the right solution. The second is, as I mentioned earlier, they really knew the domain, right? They knew, it's probably one of the best networking software teams, or just networking teams in the world. So they were doing this. So I met with Ish. At that time, it was very early. I was intrigued by the idea, but it was just too early for us. We didn't invest. And then I reconnected with him, I think maybe 5-6 months later, towards the end of 21. And then he had a little bit of traction and he was trying to raise. So, we liked the team. We liked the idea. We thought there was a path here to a really big business. So we decided to lead the A round. The company grew really well after that. One of the things that was great with this team, and I think, a lot of the people you mentioned, is just their transparency. They will be very, very transparent with how the business is doing, the challenges they're dealing with. That also made the engagement also, I think, more enjoyable, because we could have open conversations. And so the company grew well. And I think just their position in that market made them very strategic, because I think the technology was innovative. The technology made it simple to really sell into large customers. So they were a handful of potential acquirers for that. That eventually led to Zscaler buying them, like I said, I think it was April of 24. So it's just been over 2 years.
Yeah, great exit for the fund.
Yeah. Listen, in hindsight now, I did feel it at that time too, that the company could have been a lot bigger. But I think given the value that they brought, and what they were doing, I think it was a great exit for the team, for the investors. I think Zscaler has benefited from it as well.
Yeah. So you mentioned a few things here, right, across these 7 companies. You mentioned that the pain has to be there. You try to validate the urgency from the customer. Yeah. It cannot be a 6 to 12 month buying cycle.
Right.
Right. Then you signal deep domain expertise that you are looking for in founders.
Yeah.
Right. And very, very good at product.
Yeah.
Right. They have to be customer first. Right. Is that all the signals that you are looking at to make a yes decision?
So I think that's a number of it. The other thing we think a lot about is go-to-market. Can this team execute a go-to-market that in our view is very relevant for this industry, or the right way to scale? Now, it is very hard to know in the early days what works. A lot of it is experimentation. But when we think about sort of the value we can bring, and having seen this pattern across now hundreds of companies, we tend to spend a lot of time with them on figuring out, all right, listen, you, the founding team, can clearly sell. You have the domain expertise, you have the passion for the space, you have the founder title, you know the product better than anyone, but obviously you won't scale beyond a certain point. So how do we take sort of the playbook that is in your head and build a team that can go execute it? So we think a lot about that and the potential to go get to that next stage. Now then, I think there's general turn things. We in most cases we like to have a thesis on the market. There are exceptions to that, but we need to have we would like to build a view on where we think the market goes, and then where this team has an advantage that is hard to replicate.
But let's say today the markets are changing so dynamically with Anthropic launching Mythos, and the capability of models is so advanced.
Yeah.
Where do you think the moats remain? in vertical or horizontal applications?
Yeah, I mean, it is getting harder, right? So I think, listen, it's debatable what is a true moat or not. I think execution matters has always mattered a lot. It matters more. But, going back to specifically the AI question, I think if you think about the stack needed to succeed especially when you're selling to larger companies, right? You have the model layer and you have the application layer on top and the model layer at the bottom. If you're just a pure sort of application UI level company, I think it's very hard for you. But between those two, there's probably a lot of different layers, right? There is sort of a context and memory layer, which really tracks how the business actually works, the data that you need to collect. There's an orchestration layer that in many cases has to coordinate multiple agents, right? There is a governance and security layer, which is very big, right? Like, how do you make sure this agent says and does the right things at all times? Now, the models will get better at all of these, but their role, at least today, would be to provide the best model that they can, right? And everything you build on top ultimately comes down to somebody else. But, there's always risk that the models will pick a handful of verticals, like, Anthropic with coding. I think they want to.
They nailed it.
Yeah, they nailed it, right? So that becomes very risky. But do I think they'll build a product for legal that can really work inside, complicated law firms, for healthcare, for construction, for automotive? I don't think so. I mean, they'll be doing everything in the world, right, at some point. So that is where we think about where these companies can build a boat. One of the benefits, and this is a longer conversation, but like the whole SaaS to AI transition is one of the benefits that some of these legacy companies have. And I'm using the word legacy broadly. There's like companies more than 4 years old, right? So
any company older than 4 years, you will rate them as legacy.
Yeah, is that I think one, they have spent years running inside their customer environments, right? So they really understand how their customers' businesses work. And I do think in some cases they can build the best domain specifications, right? They won't build the best model, they'll leverage the model. And in some cases, the model getting better is great for them. Sure. I think they have to build the right architecture, right? To make sure governance is there, security is there, they can orchestrate agents and all that. So I think that's how you build the stack. And then I think there's also areas like, if you think about healthcare, where the deep domain expertise makes such a big difference because you can't afford to be wrong. But that's how I think about these companies that are now AI first is, what are you doing in your vertical or in your specific use cases where, yes, there's a generic prototype you can probably build using the models, but how do you become so good at executing the workflows that they have that they don't want to go with the general solution and maintain it?
Got it. And we are common investors in Atomicwork, which is a good friend and a visionary entrepreneur.
Yeah.
Right. What convinced you about Atomicwork? It was not a conventional bet with kind of ownerships and everything.
Yeah.
So why did you move out of the?
That's right. So I think there's a few reasons. As you said, Vijay is an incredible founder, right? And I didn't know the rest of the founding team then, but I'd met Vijay many years earlier, and I met him a couple of times after that. But I think one is a bet on the founder. I think two, we had some experience with the space, and we can talk more about. You mentioned For Me earlier, so that was roughly in the same space. So we knew there was a market here. Now, everybody talks about sort of the ServiceNow disruption story, but I do think there's a pretty big market, even leaving out ServiceNow in sort of the upper mid-market area, right? Or lower enterprise, or however you want to call it. A lot of that is underserved. And it was underserved historically because building a service management platform for that market was tough, because in general, service management has to provide all this functionality. It's an expensive, heavyweight piece of software. So it was just hard to build for that. I think For Me did a good job building a version of it, especially for the European market early on, which is why they got acquired. But I saw that as the vision that was very interesting, is if you execute well here, and especially if you can leverage AI to build out parts of this functionality quickly, I think the service management market has just gotten much bigger. So those were the two reasons why we invested.
And historically, let's say today deals move pretty fast. Like in 2 weeks, you need to make a decision, right? Whether you are in or not.
Yes.
So historically, how much percentage of the deals that you do or in this company you invest in, you have known with a past relationship? Let's say you mentioned some of those names, and where it just come to you and you have to make a decision.
I mean, there are periods when it varies. I would say historically, the vast majority of our deals are sort of first-time founders we've never met before. I think for me personally, more recently, it's become people I know a little bit, but the sample set is so small that I don't want to say like it's the trend. But especially when deals move very quickly and the market is turning sort of very rapidly, like it's easier to bet on proven entrepreneurs, right?
Do you go for second-time founders then?
Yeah, absolutely. We've done, we can talk about companies, but in the last 2 of my last 3 deals were second-time founders. And it is not like we're specifically targeting second-time founders, although it's great when you get experienced, successful founders. It makes our life a lot easier as well.
But they are usually expensive.
They are expensive. There's obviously fewer of them. If you look for successful founders, there's fewer of them, obviously. But it's not a requirement for us, because I think the other aspects we talked about, right? Like just the ability to recognize an urgent pain point, the commitment to build a big business, the speed at which they can move, the domain expertise, the passion. I think that can be anywhere. So I don't have an exact answer on the percentage, but it's shifted over the years. But my instinct is most people we've invested in are first-time founders that we didn't have a relationship with before. And also, as you can imagine, if you spend few years in venture, you naturally tend to have a network. So you tend to meet people who you've met before, right? When you start out, you don't know anyone. So by definition, they'll become people you don't know, right? So yeah.
Got it. And how many percentage of the company you have? 200 plus companies.
Well, 200, is roughly, we've invested throughout history. Not obviously all of them are still there. Some exited, some didn't do as well. But I think our active portfolio, I don't have the exact number, it's probably between 60 and 70.
Understood.
Yeah.
So let's say the 200 companies that you invested in.
Yeah.
How many of them were first-time founders versus second-time founders? Would you have some ballpark ratios?
I don't have a number. I don't want to guess, but I would say the vast majority, I think, would have been first-time founders. Yeah.
Good. But for first-time founders, B2B sales, especially enterprise sites, are tough. Because even if they have been in corporate, once you take away the logo, the sales become much harder.
Yes. So listen, building any startup is hard, right? I think even if you have experience in the space, you still have, because you can get your first maybe handful of customers through your relationships, but after that, you're selling based on the product, the pain point you're addressing, and so forth. So I think that doesn't concern us as much. I think what we think a lot about then is what I mentioned earlier, right? Like Tehi, one of my partners, has built this really awesome framework called sort of the customer hero journey, where he talks a lot about when you are selling to someone, put yourself in the shoes of the customer more than thinking of it in terms of your pipeline. It doesn't really matter whether, for the customer, it doesn't matter whether they're an MQL or an SQL or the demo stage or whatever, right? They are thinking about, man, do I have this problem that I need to solve? How desperate I am to find a solution. So we talked about urgent pain, right? For us, we think that's one of the best indicators of success, especially early on, is if you're truly solving something that's urgent. And I think it's very hard to figure out urgency. When you go study the market and say, oh, I'm solving this problem, would you buy it? A lot of people, if it's a reasonable problem, will say yes. But you really have to sort of figure out, yes, I will buy it today. I don't care if it's a rough, unpolished product. I need it desperately now, versus, oh, great, build it out and come back to me in a month and I'll think about it, right? Like that's very different reactions. We think about helping our founders think through, what do you say in the sales process to get them to the next meeting? We call them wow factors. We think about, how do you deliver value quickly as a product, right? If somebody signs up and you go live 6 months later, maybe that's okay for your product, but the longer the sales cycle goes, the more pressure there is the longer the product takes to onboard and launch, the more pressure there is on the sales cycle, because it's a very significant decision to try out something. Whereas if something goes live in like 2 hours, as an example, right? That's much easier for sales because they can say, just try out the product, right? So we think through all of these with the founders. And I think that teases out where the challenge is. And listen, we're not expecting people to be perfect, right?
Sure.
A lot of stuff has to be figured out. But in some cases, the benefit of second-time founders is you intuitively have figured some of this stuff out. It is harder for first-time founders in general, but great founders can execute no matter what.
So for entrepreneurs listening to it, what would be, when they reach out to Storm, let's say we are cold versus warm channels, what would their expectation for turnaround times and investment process look like?
In general, I tell people, and there's obviously variance here, is, from first meeting term sheet, I tell them 3 to 4 weeks, right? Yes, some deals have moved faster. I don't think deals have really taken much slower. I mean, there are definitely companies we've met once, we haven't invested, we reconnected 4 months later, and then we invested, like AirGap, but I wouldn't count that as 1 6-month cycle because we paused in the middle. So what I would tell, 3 to 4 weeks is the answer to your question.
Understood. And let's say out of the companies that you invest in, like how many cold reach outs would you? So
cold reach outs is tough. Honestly, just because we get so many, and I know it's probably not fair, but the reality is, gosh, I don't know. I maybe get 10 to 15 cold emails a day.
Wow.
And this doesn't even include LinkedIn. So if I haven't responded, I'm sorry. It's just that I just, unfortunately, sometimes just don't have time to read everything. And then, but maybe this could be helpful advice. So a lot of cold reach out emails tend to be very generic. Hey, I'm building something for this. Can we meet? Right? Those are just hard to follow up on because you only have X number of days and hours in a week. And if I respond to all of them, I won't have time for anything. I think crafting a very good cold email which says, I am so-and-so, this is my background, this is the problem that I'm solving, and I think this needs to be solved for this reason. Like this is a massive urgent pain. And then this is our growth rate. We have customers, we have grown quickly. I think that is much easier to process and decide whether to follow up on or not. I'm still probably not going to respond to every cold email, but at least I, at that point, can make a quick decision and, at least respond with, sorry, this is not a fit or not. So maybe that's advice is, we've definitely done deals in the past where, in some cases we've done cold deals, but like it's rarer. And in those cases, and we've done deals, where we've gone, I think the fastest I've seen first meeting to term sheet, and this was not a cold deal, I think is like 12 days or something, or 10 days. And by the way, I'm talking about deals where we led the round, which is most relevant, I think, for founders, right? If you're following on, there's more time. But anyway, I think crafting a good cold email or tying it to one of our existing investments is easier for the VC to process as well at this point.
And how many entrepreneurs you would meet, let's say, in a year?
In a year?
Physical meetings that you would do?
I don't know, in a year, but I mean, if I think on a weekly basis, first meetings, probably about 10 to 12.
10 to 12 first meetings every week. So you're meeting like 50 entrepreneurs every month.
Yeah, something like that. Now, obviously, there's like holidays and like, during Christmas, I'm not meeting that many people, but like that's probably the average.
So probably like on a lower case, 300 companies in a year?
Maybe. These are very rough numbers, by the way. I may be off. Now, as I've gotten sort of later in my career, I have, more portfolio companies, that takes up time and all that. When I was early in my career, I probably used to meet like 600, 700, 800 a year because that's all I had to do. So it gets a little bit tougher as you get later because, you're meeting your existing portfolio, you're potentially meeting LPs, you're meeting just the broader network, founders who've exited, you've met in your portfolio, you need to catch up with them. But yes, to answer your question, that's probably the ballpark.
Yeah. So assume across the team of 5 partners, 1,000 meetings with new, like first time meetings would happen in a year across 5.
Oh, across all of us? Yeah, that's probably true. That's probably
And you would invest in what, 10?
Yeah, we typically do, I want to say 6 to 8 a year.
Okay, like 1.5 company per partner almost.
Yeah, roughly. I mean, some years, I've done 1 deal, and some years I've done 3 deals, right? So that's probably the average.
That's pretty low. So to build conviction only in one company a year across so many that you meet.
Yeah, and I think it depends on the level of filtering you do, right? We definitely meet companies where we think we're just not a good fit, right? Either for the stage they're at, either in terms of what value we can bring and so forth. So I think in general, I think this is probably true for many investors, but like the first to second meeting drop off is quite large.
What would be in your case? Let's say if you're meeting 10 to 12 companies in a week, how many of them would you take it to second stage?
Maybe 2 or 3.
Okay, so that's a good filter.
Yeah. And also it's not just because of our time, right? We are, one of the things I try at least to be very cognizant of is like the founders' time, right? They're probably meeting 20, 30, 40 VCs. Unless I feel like I think there's a reasonable chance this gets to, serious diligence, then it's better to just pass early, right? Like their time is valuable, our time is valuable. And the reasons could be many things, right? It could be the traction is not where we need to be. We have invested in this space. We just don't believe in that market for whatever reason, right? We have a competitive company in the portfolio. I just don't know. I mean, this happens sometimes, right? There are certain markets, like I'll give you an example, like real estate. I have never done a real estate deal.
Yeah.
It's not something personally I spend much time thinking about. So if it's a real estate AI deal, I meet the founder to try and understand what they're doing. And more than likely, I will tell them, listen, in some cases, the other partners who may know it, so sometimes I can forward to them, but like, listen, I don't want to waste your time. I just don't know it. So yeah.
Got it. And how many, let's say, you mentioned you are meeting 10 to 12 companies a week. 2, you would take the second meeting. How many of these companies, let's say, hypothetically, we discussed 300 in there, you would take it to the rest of the partnership?
Yeah. So one of the things at Storm is we tend to take deals quickly to partnership. So we are very collaborative. And one of the things I tell people when we invest is you're not just getting access to me, you're getting access to the full team. So there have been times when founders reach out to the rest of the team and say, hey, I need help with, they don't need to go through me to get to the rest of the team, right? So, but the other aspect of that is we tend to meet when anything I think is interesting, we talk about as a partnership, right? Because, other people have looked at similar deals, right? Other people have invested in similar deals. Other people may have folks in the network I don't know about, or I have loose connections to that may be able to help. So I would say a high percentage of those, maybe 70, 80% get at least talked about in the partner meeting. It may not be a long conversation, but this is why, because if I have a second meeting, I like something about it, right? This is why it's interesting. This would be the thesis. This is what we need to see to get to an investment. What do you guys think? Like push back, maybe somebody has invested in one of these companies 10 years ago and I think it's a terrible market. Anyway, that's who.
And how many, let's say that discuss in the part, but how many would you really make the entrepreneur discuss with the partnership?
Full partnership? Gosh, I think in the year, maybe like
10?
More than 10, I would say. Maybe like 30 to 40.
Okay, so out of 300 companies that you see, you would make 30 to 40 companies?
Yeah, maybe no. Oh, sorry, just mine. I was thinking more about the 1,000. So maybe it's like 30 to 40
across
in the 1,000.
Across the 1,000.
Yeah. But the one thing I would say is, in a lot of cases, we work in teams of 2. So even if I think a company is interesting, typically one other person on the team also takes a look at it. So you would meet a second person from Storm, I think, reasonably soon. But the full partnership probably is something like that. So 30 to 40 out of 1,000.
Got it. And only 6 to 8 get an approval.
Yeah, ballpark, right? we tend to involve the partnership more aggressively. I don't know what's the industry average, but because I think there's feedback that, well, at least I can benefit from, especially T and Ryan, who have so much experience. So, and generally we are all pretty good with that. Like if somebody wants us in a meeting, we're happy to do it. I think especially today with how quickly things are going, it's great for us to also like learn and see what other things are.
Sure. So when the founders don't come from pedigree, what their chances are for?
I mean, it depends on what you define pedigree, but we are not looking for a certain template at all.
Sure.
Right. I mean, of the companies you mentioned, I mean, none of them, I think, came from, actually, I hope this is true. I'm not, I don't remember all their sort of backgrounds, but like, it's not like they all came from Stanford or anything like that.
Or second time founders.
Yeah. I mean, if you think about, Ritesh was the first time founder. Deepti at Mayala was the first time founder. Core at For Me was a first time founder. Ani at Dasara was not a first time. It was second or third, I think third time founder. Yeah. So in a lot of these cases, these are not from pedigree or like have this incredibly well documented success.
Yeah.
Like Jay at Tekion, clearly incredible run at Tesla. So you can call that pedigree if you want, right? So, but a lot of these people are very smart, very successful in their own ways, but it wasn't like they came from like what a Jay did or like sold a company.
Yeah, maybe Tesla in 2016 was not so popular.
Yeah, it wasn't so popular, but you could see why he would be the right person to build this for the automotive space, right? And anyway, that's the way.
Understood. And you have companies like Atomicwork where the founder started from India and then moved to the US.
Right.
You have companies like Spina, the company which is purely India based but selling to the US market.
Yes.
And over a period of time, Sanjay has started spending more and more time
here. Yeah.
So how many of these companies you would do?
Yeah. So I think a significant chunk of our portfolio, I don't know the exact percentage again, is founders of Indian origin, right? Many of them were born and raised in India. We have some that were born and raised here. I think in most cases, at least one founder is here. Almost everyone has teams in India. So we are totally fine if most of the team is there. I think in general, you have to be in the market you're selling in. So it is rare, I think, that a team can be fully based, let's say in India, and then sell into the US. You can maybe for some kind of products, but in general, as you get to like mid-size and enterprise, like they want to meet you, you need to hire people here and so forth. So I think in most cases, there is some presence here. I think that's not just true for India. We invest globally. Even other countries, typically a founder moves here.
Got it. And have you seen a specific patterns that you try to learn from the portfolio that became huge outcomes? Let's say Tekion, Marketo, and others. Like they became like 4 or 5 billion outcome.
Yeah.
You couldn't have predicted in the beginning that they will become such beginning.
I think having this will seem very generalized, but I think maybe there's a couple of things. I think one, having a product vision on where having a product and market vision. Like I believe this market will go like this.
Yeah.
And for that, this product needs to exist. Yes, you have to prove everything out.
Yeah.
Right? It's not easy to say that 5, 6. But I think a really strong product vision is important to that. Because you need to be building towards something. Yes, it'll move multiple ways in the middle. So I think that's true with Jay. I think that's true with Marketo as well. So I think that. And I think second is just sort of, this will feel very like touchy-feely kind of thing, but like just that relentless focus on execution. And, this may not be the right way of saying this, but I'll do whatever it takes to make this company succeed.
Yeah.
Right? I think the companies that have done well, that is not, I think, sufficient for success. But I think, if I have to pattern match across some of the successful companies, I mean, they would, for lack of a better way of saying it, not let the company fail, right? that sounds a bit cheesy because so many things are
Every entrepreneur does it.
Yeah,
doesn't want that.
exactly. Every founder wants that. There's so many things outside their control, but I'm trying to pattern match on the successful ones. And I think part of it is just the founder's personality makes a big difference.
So you're saying relentlessness matters a lot.
It does, yeah. Because every company goes through challenges, right? And again, I don't want to make it seem like that is the reason only for success, because a lot of things are outside your
No,
control.
that's a necessary but not sufficient.
Non
condition.
sufficient thing, right? I mean, a lot of luck is involved. Clearly, a lot of luck is involved. Markets change. Regulation changes. I mean, even with Tekion, such a great company, let's say the regulators change something, right? It could have hurt the company significantly. And I'll go back to what I said earlier, right? Like I think to build a big business, you really have to understand, what the journey the customer is taking, right? Like some of the things I mentioned, like, are they really solving a problem that they care about?
Yeah.
And as you become big, you launch multiple products and you have to kind of redoing that journey. So those are some things I would say.
Yeah. Today, the entrepreneurs that are starting, there are a few challenges, when they go to raise. Obviously, the top 0.1% or 0.1%, the VCs go after them.
Yeah.
Right. But I would say the remaining part, let's say, if there are 100 companies in the market, 10 definitely could be large outcomes. One of them, obviously, every VC is going after,
Yeah.
but the rest 9, there are few challenges for them. One is the question that they get is, can Anthropic come in your domain? And the second is, there is no clear exit path. Earlier, the exit path could be, let's say, for your stakeholders, the company at 100 mil ARR, 200 mil ARR, right, could go public in the US market. But that doesn't exist today. And the bar for public, has gone up like immensely high.
It's much higher. I mean, this is a good question. I think it depends a bit by sector as well. If you're starting out now, yes, you obviously have to think where is sort of the leading edge of the models and how quickly they're moving towards whatever sector you may pick, right? I do think over time, today a lot of the value has been accrued in the infrastructure and model layers. I do think over time we'll start seeing value getting accrued in the application layer. Sure. So I do think there's opportunities for big companies to be built. I also think that the models will not build everything like we talked about, right? Certain things they will, because that's core to them. So I think still there is opportunity for you as a founder to figure out the right vertical, the right product to build, make sure you deliver what the customer needs in terms of, like we said, governance, security. Essentially, like if you go to them and say, listen, you want this outcome, right? Higher sales, better healthcare for your patients, higher revenue, whatever it is. I will deliver that. What is it worth to you? Now, underneath, whether I'm using fully AI, whether I'm doing services, is not as relevant to the customer as long as you deliver it at a price point that they care about. Now, obviously, the pricing pressure comes from, they'll say, oh, I'll build it with Claude, right? But customers, for the most part, are not set up to build a lot of products that are not core to the business. Yes, the engineering team can say, oh, this is easy, I'll build it. But are they going to maintain it for like 10 years, right? Are they going to make sure when compliance and audit comes through that they're going to sit and figure out all through the logs? So the thing that I think I would encourage founders to think about is everybody has some level of core competency, right? A manufacturing company's core competency is obviously building products. They will not go and build everything. And I think there's a big gap, like I mentioned earlier, between the application and the model. So go build for that gap. Deliver the right outcome to the customer at the end of the day and work with them on thinking through a price point that makes sense. Now, depending on what value you're providing and what pain you're solving for, it may be that the price point is not enough to sustain a business, or that price point may only support a certain go-to-market, like a product or go-to-market. So those are the things that as a founder, you have to figure out, right? Your passion for the problem, understanding what the outcome the customer wants, building the right pricing and go-to-market for that. And I think there'll be many of those. Now, going back to exits, this also defines what kind of exit you can get. In some sectors, especially like cybersecurity, there's, 6, 7, 8 really good buyers. And in general, what happens is one of them starts buying, then everybody buys. And I'm overgeneralizing, like this is not fully true, but and then if you don't get bought, the question is what happens to you, right? Like, can you go become a big company? Maybe it is, but it goes back to like I would encourage founders not to like think about the exit specifically as a reason not to do some one or the other, because the things that you're building for, the reasons we discussed, right? The pain, the outcome, and all that work for you in terms of starting the company, in terms of growing the business, to getting an exit. Because if you're delivering true value, there's always someone willing to buy you, right? Whether it's an older company trying to pivot. And I think at some scale, if the value you deliver is very good, I mean, you can go public. This is kind of a weird time. I mean, comparing to Anthropic and SpaceX, it's hard to imagine anybody else going public today. But like, if you're building now, you're thinking about public 10 years down the road, right? The market is going to be so different. We will see new companies coming out all the time. The AI is obviously very different, but like if you think about previous waves, like the cloud wave and so forth, right? You know, the big companies of today didn't start out until 5, 6, 7 years after AWS came out, right? Now, yes, AI, you can argue, is accelerating the process. So in many ways, we are just in innings 2 maybe of, if you think of a baseball analogy, not a cricket analogy, but like a baseball analogy of this journey. So if you build now, you think, who knows what the market looks like in 2035. So yeah, but yes, that's the way I would think about it.
And what's been your learnings from companies that you were very bullish about, invested in, but they didn't work out?
I think, let me talk about where I think we made mistakes, right? Because I think in all the companies I can think of, and I won't name names, but like, I do think the founders did a really good job executing. I think some cases we didn't identify the urgency of the pain as well, right? I think it was a important pain point, but it wasn't urgent enough, right? I think in some cases, we could have done a better job helping the company manage cash. Because there have been cases where I think these companies could have had big outcomes. We burned too fast, and then you just never get that shot, right? In some cases, the market's turned a little bit in terms of the regulation made the pain point not as urgent anymore, right? So I think out of all of them, the thing that we could control, if you want to say that, is I think really pushing the team, just keep thinking about, is this something that the customers desperately want? Because I think if you take your eye off the ball, when the market turns and budgets get tight, you'll get killed, right? And then it is very hard to do this. See, in hindsight, all of this seems like obvious stuff, but being, in some cases, we could have been more prudent with cash. But sometimes when things are going great and you want to accelerate, maybe this company should have fundraised earlier. But those are things that, in hindsight, we could have done. I think the third is just tied to hiring, right? I have seen this in some cases, and this depends again a lot on founder personality. Is when you're growing fast, the instinct is to lower the bar for hiring because you want to get people. You're like, I need people. That can obviously work out well if the company does great, and which is why I'm saying some of this is hindsight, right? But that increases the risk profile of the company significantly.
My learning has been we have had 65 companies in Neon across last 7 years.
Yeah.
The reason we have 6 to 7 companies that didn't work out or down, the common reason among all of them has been lack of product market fit.
Yeah. But again, like then the question, first of all, you invest very early. You invest much earlier than we do. But then the question is, why wasn't there product market fit, right? Like what was the cause where the ultimate symptom or outcome was no product market fit?
Yeah, I think it can be back to the same what you mentioned.
Yeah.
The pain might not have been deep enough, or there was a misunderstanding on part of the team on understanding the pain. Like there was some other pain, but because the customer never like opens up 100%. Even the customer doesn't know that this is the exact pain, which is a burning problem, and the team starts building for something else.
That's right.
And both are never on same.
Yeah, and then you don't have enough money to.
Yeah, and you run out of money, right?
Yeah, exactly.
Common
so
thing
that happens a lot.
Yeah, like because I've seen like companies and usually even let's say would reach $1 million ARR, but get stuck. There's no new round happening, and there's a downward.
Yeah, I think the $1 million ARR is important because I mentioned this very early in the conversation, right? Is I think that transition from when founders are selling, because the founders can often get traction that's not repeatable, right? Because the founders obviously they have the passion, they know the space, they know the product, they can say we'll build this for you, and when you're selling at that stage, typically you also tend to get early adopter customers. There are customers who are like, I like working with startups, I believe a product like this should exist. But that is not the vast majority of the market. The rest of the market is much more clinical in how they decide to evaluate or buy a piece of software.
Yeah.
So I think that transition from whatever it is, 500K, a million, 5, 10, 15 customers to your next 50, where you're going from founder-led sales to a go-to-market team is a big sort of gap, right? Which is that's part of the area we spend a lot of our time on, is we try to identify, can this gap be bridged in some way, or what needs to happen for the gap to get bridged. So yeah, it's a very tricky thing, but what you said, that's the conventional wisdom, right? Is you get to $1 million ARR, you raise a Series A, whatever the amount is, you hire a sales leader, spend money on marketing, and growth will come. But it doesn't, because you have to do a lot of work to get there.
Yeah, because we have seen companies even at like $1 million ARR, even if not founder-led sales.
Yeah.
Because there was not enough product market fit at that stage.
Yeah.
The sales become much harder.
Much harder. Exactly. Yeah. I mean, it's not an urgent pain. You don't say the right things in the sales process. You're not delivering value quickly enough, like I mentioned. So all of this puts more pressure on sales to convince someone.
Yeah.
And the best way to convince someone is if you deploy the product and it just works, right? Or they are so desperate for it, they're like, okay, I get it, but I want to try the product now because I need something. So in many ways, I think, as you said, product market fit, especially at the stage you invest in, is a key sort of breaking point. But as we think back and, do sort of analysis in hindsight, we try to think through what were like the signals we could have caught earlier on, or what questions we should have asked, or how much more time. Now, this gets tricky these days because the rounds are moving fast, as you said. So you don't have a lot of time to do this, but those are some common reasons.
So for us, the thing that we have, learned is every new dollar that comes in, if there is product market fit, becomes much easier.
Yes, absolutely. Yeah. The return on that is much higher.
Yeah, every new dollar becomes, and some of the signals maybe to evaluate that is the CAC keeps on going down.
Yeah, your payback period goes down. Yeah, you're right. Absolutely.
Yeah, and eventually there has to, even at either SMB or at enterprise, the word of mouth has to kick in. If word of mouth is not kicking in, if only a sales led, then probably there's something wrong, and and eventually it will break out.
Yeah, because you can't scale that indefinitely.
Yeah.
That's a good point.
Sales is becoming more harder and harder in AI waves.
Yeah. There's also a lot of noise in the market.
Yeah. How is software buying changed? Because you speak to a lot of the CIOs and buyers.
Yeah. I think just the amount of research that people do in advance, and in some ways you can argue that people have already made a decision, right?
I'm not able to understand.
So if I'm a buyer, I'm making this up, but like if I'm a buyer and I'm looking for, let's say, a AI security product, right? I think now AI security is very crowded, so maybe this is harder, but they have the tools today to do the research, look at 50 companies, look at certain criteria, narrow that down to 2 or 3, and say, I'm going to pick between these 2 or 3. It's the right product profile, it's the right set of features, it's the right price point, its product is simple enough that I can test it very quickly in like 2-3 weeks, and I can make a decision. So then, if you have 50 companies and 50 salespeople reach out to you, you may pilot more. Like I've, talked to CIOs where they're like, man, I'm piloting 20 products, but I don't think I'll buy any of them, right? Because they have done enough research in advance that they know exactly what they need and they're looking for that signal. So that's, I think, the other challenge, both for the buyers and the startups, is there's a lot of noise in the market. And this is changing now, but like the pace at which real transactions, for lack of a better way of saying it, is very low. So I think, and this has been happening for a while too, but I think the buyers in B2B software today are much more prepared and aware of what they want and aware of what the options are. So, which is why the sales process becomes even more critical, right? Like you can't get them for like 4 meetings before they make a decision. You need to deliver value or highlight the pain in the first meeting.
Yeah. So there is no time for discovery then.
There's not much time for discovery because, they can go online, create an agent, do a search across. Yes, there's always a chance that a vendor that they couldn't surface comes in. But in general, you're probably going to hit 70, 80, 90% of the solutions. And then you can set your benchmarks, what you're looking for. You can prepare for that. And then, they are almost at like, okay, I have 4 vendors. I'm going to pick from one of these. Let me try those. I'm not going to sit through 50 vendors educating me on what the problem is and what their product does.
And what about the traditional wisdom of building a champion, then building a team, like knowing a 10-member executive team inside the enterprise?
Yeah.
How much of that is valid today?
I think some of that is still valid, especially if you're selling to large enterprises, right? I think you still need a champion who is going to champion your product because there is risk, right? Especially if you bring in AI tools, they need to perform at a certain level of accuracy. Yeah. They can't, and the more complex the use case, the more mission critical the use case, as in healthcare, the bar gets higher and higher. So somebody at some level is sticking out their neck by bringing you on. I'm not saying pilots, right? I'm saying actual production deployments. So I think a champion still needs that. You still need to convince, other parts, maybe IT, maybe procurement, maybe finance, especially finance now, right? Where these AI products that come in, they're coming in at a pace that wasn't true before. They may consume, depending on your pricing model, especially with usage-based model, right? Like suddenly your org starts using it or doesn't use it. So it's not like we're shifting away from the standard subscription model more to a usage-based model. And ultimately, a lot of people are talking about putting FTEs and are doing this, putting FTEs and delivering outcomes. So, but you still have to convince the broader org. Now, the pace of that, I think, has accelerated. The other benefit with some of these AI products is that you can deploy and show some value very quickly, right? The days of, I need 6 months to integrate and onboard makes it, I think those days are harder to at least those kind of products are harder to sell because 6 months onboarding is a very long time, right? So it's evolved a lot, but I think stuff you mentioned is still very relevant. It's on an accelerated cycle.
Yeah. And what do you think about new categories like voice AI? Have you invested in any?
Yeah, we have a couple of companies. Like, for example, we're investors in a company called Krisp, KRISP.
Yeah. That's quite a scaled company, right?
Yeah. They're a decent scale now. They've done a lot. Started on noise cancellation. Today they do, accent localization and a number of other products. Basically, if you use voice in your platform, right, either internally or as a product, like the Krisp API can provide you a lot of value.
And they also build agents?
They are starting to, but today they're more, they provide a full solution, but mostly you build on top of them for certain use cases. So, we've done that. Synthpop, which is a healthcare AI company that I invested in last fall, they work in something called the durable medical equipment space. So and they're expanding beyond that, but that is the space they started in, where there's a very complex process from when, if your physician orders a medical device, and I'm using device broadly, but like, a wheelchair or a sleep apnea machine or glucose monitor, what happens from the physician ordering to who services that order, like a vendor? How do you verify insurance? How do you get it to a patient? How do you handle delivery? How do you handle feedback, replacements? It's a very, and because the reimbursement on this is very complex, there's like this massive flowchart of what a human needs to do, right? So they are using agents for that. And a big part of that is calling insurance and patients. And, some of these calls can last 1 hour. So it's not like an agent that asks a question, hangs up. So that's a good example. So voice AI, I think, is a great medium going forward for a lot of this, especially where you have to interact with humans.
And what's the lowest ARR, or like one is lowest and the other is average ARR that you usually come in?
So we have done companies at incubation in founders we know. It is rare. I'm trying to think of an example where we've done it in people we don't know. I think it's unlikely. So beyond that, I would say the average is a tough number, but I think we've done everything from companies that are at a few 100,000 to a few million to start off with. Again, I don't want to say like you have to hit $1 million ARR. The number also depends on the team, how strong our thesis is in that market, how competitive it is in the market. Like, I'm just taking a simple example, right? Like if you are building a new sales automation tool using AI, there's a lot of companies doing sales automation. So there it's unlikely if you're at 100K, we would come in, or let's say 100K is too less, but let's say at 500K, because there's probably 100 companies doing that, right? So we need to show something, we need to see something that you're building that approaches the market in a different way or solves it for a different buyer or a persona before we would invest. So there the bar is a bit higher in terms of traction. But if you're building, there's a company called Tote, which I mentioned to you before our call, building something for convenience retail. That is a market that every deal is like a 7-figure deal, and you have to build a lot before you get to revenue. And there's really not much competition. So there we may be willing to take an earlier bet.
At zero revenue.
In that case, we did zero revenue. Again, Shyam is a second-time founder, so it breaks the mold a little bit in terms of maybe the question you're asking. But then we can understand why the traction is lower and we can take a bet. But I think for your listeners, gosh, like $500,000 to like 2 million is like, let's say, the range. But like everything, there's exceptions to that.
Yeah. And do the most of the companies that you see are in that range?
I mean, it fluctuates. We definitely see earlier companies. And by the way, like in some cases, the investments we've done, we met them when they were very early, but we kept in touch and we did the next round, right? So that works out. So I don't want to make it seem like we don't meet companies early. In fact, I meet many companies that are earlier than us. And there are many times I've sent them on to other funds that do pre-seed and seed. And in some cases, they have invested too. And if you like the team and the idea, at least I try to stay in touch, and then we can potentially lead the next round. So, but yeah.
Got it. And I assume out of the 200 companies, right, that you were done, today you said just 60 to 70 live, right? So it would have, like the remaining would have been like around 40, 50 shutdowns and 40, 50 exits.
Probably, if I think about every exit, and I'm not saying the exit was great in every scenario, we've had some very good exits. But yes, I would say a bunch failed, maybe like, as you said, 50, 60. I think we've seen a lot of, in our history, like the capital returned or like a 2x. We've seen a lot of those. Again, I don't have the exact numbers, but I'm sure there've been a bunch of those, and obviously some bigger returns.
Yeah. So how many, I know it's not a right measure, but how many unicorns would Storm have in the history of?
So I think we've had 11, if I remember.
Which one would be some we discussed, like Tekion, Workato?
Yeah, I mean, Tote, Tekion, Workato, SplashTop, Marketo, MobileIron from the earlier days. Trying to think who else. Yeah, those are like 6 or 7. This is another 4 or 5. Yeah.
And which are the most recent ones?
Well, Tekion is probably the most recent one, because they raised 2 years ago, 3 years ago. I think Tekion is the most recent one. I think so.
Got it. And when companies accelerate, let's say from 1 to 10, you obviously mentioned the transition from founder-led sales to like a professional sales team handling the sale. What are the biggest accelerant that you have seen from companies which go from 10 to 100?
Yeah, so I think there's a couple of areas. One is, as we mentioned, as we discussed, the go-to-market becomes very repeatable, right? You are able to, at some level, predictably say, if I invest 20 million in this business, I'm going to get X out. I think second, in most cases, we have seen companies launch a second product, right? And that product has its own journey. But your initial product is growing. You launch a second or maybe even third set of products beyond that. Third is, and some of this is cause and effect, is hard to argue, but like you bring on a more seasoned team, right? The team that got you from 1 to 10. And in some cases, we've had leaders scale across it, but you get a team that is more experienced with sort of building out and scaling. Now, AI is changing a lot of these, but those are some things. I think the stronger, we call this unlocking growth, that founder-led sales to a go-to-market team. Like, so before you scale your growth, we have to unlock growth, and we've built a lot of frameworks around how do you test for it, how do you go about finding it, how do you measure it. But I think the stronger that is, the easier it becomes. And then once you get to later stage, you have a lot of, because a lot of it becomes number driven at that point, you start having signals on whether it's working, not working, what are some early signs of it, things like that.
And do you see in the current AI wave, product market fit also changing dynamically for companies?
Yeah, I mean, it is changing in the sense that the pace at which you can get a buyer and potentially even churn is much higher, right? Because the AI products, one of the benefits of that is it is easier to build, but also I think it is easier to put it in and replace it, right? In some cases, it's harder, like especially in like certain industries or like certain products, like with compliance and all. Maybe that's not a good example, but 10, 15 years ago, it would be much harder to like get a product in, but then ripping it out would be much harder, right? So now, especially if the customers have done a good job, managing their data, building models on it and so forth, and depending on how the rights there are assigned, you can get people in and out very, very quickly. So that increases risk a lot. So yes, you can get product market fit very quickly, but the next product comes along and they can deploy quickly as well, which is why when we talked about earlier, I think companies really need to think about how are you building that full stack between the AI model layer and the UI. Like you need to own that entire thing, because if you own the entire thing, at least in some verticals, it is a lot of work to rip you out. And second, if you build that well, as the models get better, your product just gets better. So if somebody comes in next and they're also using the state-of-the-art model, it is hard for them to offer a much better product than yours, unless you just designed yours badly, right? Or you don't understand the pain. So I think you compete there going forward.
So today, if you have to think about 4 to 5 themes that you are most excited about, or thesis that you are building internally, what would they be?
Yeah, so one is I really like verticals like healthcare and construction, and Tote does convenience retail. We invested in a company called Flywheel that is focused on cloud marketplaces. So I don't want to say these are like, I don't know, off center, maybe the wrong word, but they're not like straight down the middle, right? So that is one area we're spending a lot of time in. I think second, we're spending a good amount of time in physical AI. I think, how AI and can accelerate sort of hardware development, how it can do tasks that, previously would have been very difficult to train for and build for machines and robots.
What do you mean how AI can accelerate hardware development?
Well, like we've been talking about like how robots can do work in homes, or like, there are companies that automate, obviously self-driving is a great example, but like industrial use cases like for security or in mining and so forth, right? Where machines can now be much smarter in how they behave. I think we'll see more and more, or assembly lines, right? Like how can machines be better at picking? So here's a simple example. In many cases, if you have an assembly line, what would happen is if the assembly line was making X, you want to change that to making Y, there was a big refit that needed to happen, right? Or, you have to retrain people and so forth. a big push in physical AI, and obviously there's risks of job losses and all here, is that you're building machines that can do multiple things at once. Let's say a human or robot, right? Where they can just adapt to whatever is coming, right? So that's an example of physical AI. So I think there'll be a whole industry that's built out where, given the data sets that are available, a lot of it is visual data, and the right world models that are built around it, you can train these machines, and I'm using machine very broadly, or robots, much faster than what was possible before.
You're saying training data for this physics machines.
Yeah. And with self-driving cars, it took 10 years, 15 years
to get the data.
And obviously a car driving is a very high risk.
Yeah, you cannot afford one accident.
Exactly, right? So, but like picking fruits is like a lower bar for that. So I think that is an area we're spending time.
Are you also thinking of let's say more hardware getting developed, so AI for AutoCAD kind of things? Is that also interest?
Yeah, I mean, I think, listen, any software that follows roughly a set of rules and is algorithmic, I think AI is a great use case for that, right? So if you're doing design or CAD where there's a set of best principles, I think AI does that well. Anywhere that requires a lot of human judgment or design thinking or creativity, I think AI will get there reasonably well, or maybe it can do a good job if you have no creativity or skills, but then that's where it becomes much harder, right? So if you're in an assembly line, I'm just using that as a very general example, and it's a very repetitive task. That's where the AI can get good at, because it's repetitive. You can train it tens of millions of times very quickly.
And what are the other things?
I mean, I think we're continuing to look at areas like cybersecurity,
Sure.
Right, where there is a lot of budget. And I think in a lot of one of the interesting trends across all of these is just the business models are evolving. We're going from, as I mentioned, from pure software to a more usage-based or outcomes-based.
Yeah.
What you offer underneath in terms of, is it pure software or is it software and service?
Yeah.
A lot of companies are shifting there as well. So I don't know if you call those themes, but those are the areas we're looking at.
Understood. And any particular, let's say in vertical, you give two great examples like Tote. I've never heard of such a company building for general stores at gas stations.
Yeah.
It's a huge market.
Yeah.
Completely underserved.
Yeah.
Right. And the solutions must be really old.
Yes. Yeah. I mean, Tote is a great example. I can describe it more, but yeah, the use case is this market called convenience retail, which is, as you said, think about gas stations or 7-Elevens, like the sort of the smaller footprint stores. And the challenge, as you rightly pointed out, is I think twofold. One is they use a lot of legacy infrastructure, but two, it is a very complex setting, because you have people in stores, you have checkout, you have self-checkout, you have to connect gas to it. A lot of these are in places, with potentially in some cases you don't have great connectivity. So building out a modern platform to manage all of that. And then once you're deployed in these stores, you can build a lot of apps on top, right? Because you can build an inventory app, you can build a finance app to track how these stores are doing, forecasting. You can do so many things, but the underlying infrastructure to get these stores to adopt you is very hard. So in many ways, as I mentioned earlier, I think of it like what Tekion is doing for automotive, these guys are doing for convenience retail.
Yeah. So this is a perfect kind of vertical that you would like to attack.
Yes. So this is great. I mean, it's obviously not very simple, because it takes time to understand the vertical, and in some cases you do need a very experienced model, which is why I mentioned domain expertise, right? Like this would be hard to do for someone who was doing something completely different and said, okay, I'm going to build in this space, right? Not that it's impossible, but the bar becomes higher because the sales cycles are painful. You really need to understand how these people buy, what are the signals, and the lift is heavy, right? Because you can't build a small module and say deploy, because you have to run the entire store. So the 0 to 1 is a big step. It's not like you can get 5K, 10K ARR and scale from there.
Yeah, you have to, and all these smaller convenience stores are not owned by one business owner.
I mean, there are chains, but you're right, there's many chains. And you have to go convince someone to say, by the way, this store that does $500,000 a year or $1 million a year, or maybe even, 5-10 million a year, is going to run on my software, right? And if it's doing a decent amount of business, actually $500,000 a year is probably too small a number. Like, it's probably millions a year. And you have an outage for like half a day or a day. I mean, that's potentially tens of thousands or hundreds of thousands. That may tens of thousands, hundreds of thousands of revenue. So it is very high impact. That is hard to test, by yourself. So, you mentioned earlier, I think, I can't remember, maybe it was before we started, how, Tekion had to build their own dealership to really learn, right?
Jay mentioned to us that the first deployment was their own dealership that they bought.
Yeah, exactly, right? That's how you test. I remember in the Tote office in the Bay Area, they have fuel pumps that they connected to and tested. So like actual, you have to go get a fuel pump.
Okay, so did they build a fuel pump in their office?
Yeah, I mean, there's no fuel passing through it.
But just the billing.
But the billing, what happens when you press this button, what signal do you get on the wire, all of that they had to like build.
Very complex.
It's very, very complex. Yeah.
Oh, amazing. Thank you so much, Arun.
No, thank you. It was great questions. And congrats on your success too. You guys are doing really well.
Thank you so much. And would love to work together more.
Of course. Yeah, me too.